Welcome to webinar on FRM Part 1 topic, duration. Thanks for joining this webinar. Feel free to post your query in the chat window, the question window. We plan to get back to you as and when we read the question. In case we are unable to get, we will email you the answer to your query after the webinar. So before I started with the 1-hour education webinar, let's get a quick introduction to EduPristine. So EduPristine is an authorized CFA provider. They deal with CFA trainings across the world. So if you go to the CFA Viewed website, you will actually see EduPristine shown as an authorized training provider. We are also associated with GARP, the body which runs the risk professional certifications. We are authorized training provider for FRM, which is what you guys are targeting. When we say we are authorized training provider, it means all our content and trainings are reviewed by this body, and it is up to date based on the latest changes for exam preparation. We are associated with FPSP India for training CFP, Crimea, MIA, the authorized training provider for PRM and APRM exams. So not just authorized training providers, we are closely associated with all the big organizations like Ernst & Young, BOA, JP Morgan, and various other big banks across the world to address their training needs in financial modeling, risk management, quantitative analysis, and many others. We've got key associations with various B schools across the world, National University of Singapore, IIMs, FMS, and various other top B schools of the world. The content is developed by practicing professionals along with academia from these institutes. And finally, we've got complete online presence across the world and training centers at Singapore, Middle East, that's what we are targeting, USA, and all the major cities of India. Successfully conduct more than 700,000 man-hours of training so far. So with that introduction, let's get back to our key topic of the day, which is called duration. Now, duration is the measure of how long an average, the average keyword is important, how long an average bondholder should wait before he receives his payment on the bond. Bond is a fixed income security which generates coupons, finally the principal payment on the maturity. I'm creating a timeline here which starts with year 1, year 2, year 3, and a maturity point. So the bondholder received coupons which are fixed, that's why it's called fixed income security, and he received the face value or the principal of the bond. Okay, now the bondholder must hold this bond till some point. He can hold it till 1 year or he can hold it in maturity. We are saying the bondholder should hold the bond till a point in time. How long? Has got a unit of time. So duration has same unit of time. So some point in this timeline is called duration, and this is the average time, and it's a weighted average where weights are defined by the cash flows. Okay, and this is the nice point where your yield of the bond is guaranteed. The yield of the bond is fixed. Now there's a question, what is a yield of the bond and how it is different than coupon or coupon rate? The coupon or the coupon rate is fixed for any bond, but the yield keeps changing, and in fact it represents the interest rates, okay, in the market. Okay, the yield of the bond keeps changing because interest rate in the market keeps changing. And yield is my return, the bondholder's return. And if the interest rates are changing, even if coupons are fixed, my returns from the bond changes, so yield changes. Okay, so if I want to guarantee a particular yield, I should hold the bond till duration of that bond, not till maturity, but till the duration of the bond. Okay, so a coupon paying bonds duration would be lower than N as the holder gets some of his payment in the form of coupons before N years. If you take a weighted average line, 1, 2, 3, and maturity, which is year 4, and if it is weighted on the coupons, right, cash flows that year, if you have a higher coupon, right, then the average will shift towards left. And if there is no coupon, right, just like a zero coupon bond, then the average will be same as maturity because whole of the weight is applied to maturity. There is no weight to these time points, and the average will be 4. So for a zero coupon, remember this, for a zero coupon bond, duration is always equal to the maturity of the bond. So you don't need to compute it. All you can say that if I know the maturity for zero coupon bond, 10 years, duration is all 10 years. If I hold it for 10 years, my yield is guaranteed. Whatever is initial yield, let's say 5%, I'll continue to get it. My question to you is why my yield is guaranteed if I am in a zero coupon bond? Thanks for answering that, Mustafa. The answer is my yield is guaranteed to 5 because there is no coupon coming out of it and I do not have any reinvestment risk. Okay, even if market interest rates goes down, my reinvestment risk is 0 because no coupons are coming out of it, and since coupons do not change, the yield remains fixed. The net return that I get remains fixed. Okay, we have got the idea that duration is a special point on a timeline where interest rate risk, right, balances the reinvestment risk and my yield guaranteed. I am guaranteed to get a particular yield if I hold on beyond the point of duration. So let's say this is my duration point, just 2 point. If I hold the bond till 3.5 years, or if I hold the bond till 1.5 years, in both cases, my yield is not guaranteed. So either my could be higher or lower, higher or lower, depending on the interest rates in the market. Okay. If I want to ensure that my yield is guaranteed, I have to hold it exactly till the duration of the bond, and then after that sell it. Okay. So you've got high level concept of duration. This is an average time till which you must hold a bond to guarantee your yield. Okay, below and above this time, the yields are not guaranteed because either reinvestment risk will go up or interest rate risk will go up, right? And either way, your yield will change. And in a fixed income portfolio, I want to ensure that my assets are matched with liabilities. In other words, the yield of the liabilities must match the yield of the asset. The matching is important. Higher or lower yield is not important. So I should not worry about whether yield will be higher or lower. I'm more worried about guaranteeing my yield so that I can match my assets, which is a fixed income bond, instead with liability, which is a cash outflow. Okay, so that gives us a fair idea. Now let's talk about the formula to compute Macaulay duration. Looks a big formula. How will you remember that? Quite easy. Careful and you will find it's quite easy. What we have done is we have multiplied the numerator with time. Can you see the time here? The cash flow are discounted to get the present value. So every cash flow is discounted to get the present value and multiplied with the time. This is the maturity. Okay. So you can say nth here is the maturity, M is the final face value or the principal of the bond discounted with the nth year, the last year, the maturity year. And once you have multiplied, you divide by the total price. Okay. So what are the weights? Let's take a quick example. The following cash flow diagram. So the current price of the bond, 964, it negative sign because if you buy it, it's an outflow. Okay, the coupons of the bond are 40, 40, 40. On the fourth year, 40, and the fixed value, which is 1000. Okay, now if you assume the discount rate or the interest rate to be 5%, and the question is how to determine the duration using the big formula that we created here. Remember a big formula? How to do that? All you have to do is take a weighted average with the cash flows. What is the weight of year one cash flow? The weight of the year one cash flow, first discount it till time 0. So this is the discounting the present value of cash flow at time 0 on year 1 divided by the total price will give me the weight for year 1. Similarly, discount the year 2 cash flow to get the present value. So I divide it by 1.05 square. So 40 divided by 1 plus discount rate squared to get the present value, divided by total cash flow to get second weight. Similarly, weight for the third cash flow and present value of the fourth year cash flow. Here is the present value of fourth year cash flow multiplied by the time, fourth year, and divided by the total price. I hope you can easily guess the price that I got, right? The price that I have got here is nothing but sum of present value of all the future cash flows that bond will give to me. So I have taken their present values and sum them, and if I sum them, what I'll get is this number. So if I divide the present value of individual item by this number, I am getting weights in percentage, right? The sum of the weights has to be 1. So that's why you can see that this is first weight divided by this number. I have taken this common because I am dividing with price with all the items. Second weight, third weight, fourth weight. So this is the weighted average of time, and time is 1, 2, 3, and 4. That's it. So I got the weighted average to be 3.77. The units has to be in years, right, or 6 months. The units has to be in time. So if the coupons were 6 monthly coupons, so this was not 1 but 6 months, 12 months, 18 and 24 months, then you're going to divide the answer, which is in 6 monthly, by 2 to get 1.89 years. Okay, so the units used for 1, 2, 3, and 4, right, has to be same for the duration, right? And if you want to convert them into years, you have to divide them by 2. Okay, so that's how you actually compute duration, which is a weighted average of timeline where weights are present value of cash flow at that time divided by total price. So to compute the duration, I need all the cash flows and their time points. And if I take a weighted average, 3.77, then I know after 3.77 period, somewhere here on the timeline, right? After 3.77, what I get is the point in timeline till which I should hold my bond. Okay, and if you don't hold the bond till that point, then your yield is not guaranteed. Okay, so while it comes up, there is not just one duration in the system. We continue to make the duration precise based on the nature of the bond. Okay, this is the most basic definition of duration, which is the weighted average of timeline with cash flows. But in the next few slides, you will soon see that there are other definitions of duration, and we would like to make them accurate. Okay, here we go. So we were here at this point talking about an example of the duration. Okay, any questions at this point on this? Let me know. Okay, there is another purpose of duration. Once you know a Macaulay duration, the one we calculated is called Macaulay duration, right? The easiest of the all, right? Once you have computed this Macaulay duration, right here, it is also used to measure the sensitivity of the portfolio's price to the change in interest rates. Okay, how to do that? Remember, the price-yield relationship of a bond is downward sloping and slightly curvature. As interest rates in the market increase, the price of the bond drops. Why? Because you will have a higher discount rate. Interest rates goes up, the cash flows will be discounted. Remember, the cash flows are discounted, right, to get the price. So higher interest rates means higher discounting factor means lower price. Lower interest rates, lower discounting, higher price. Okay, now if you draw a line tangent to this price yield relationship, this tangent line can be shown by an equation that percentage change in prices, the y-axis, is equal to minus duration percentage change in yield, the x-axis. Okay, so this is a straight line equation where duration is acting as a slope. So duration is also a slope of a price yield relationship, where I can safely create this formula that change in prices is equal to minus duration, it's negative slope, into change in yield. Okay, so you can also write it percentage change in price is equal to minus d delta y. Okay, so if you are given the duration and the change in yield for a bond, you can compute the percentage change in price. How to do that? Okay, consider a bond trading at 96.54. This is the bond price today. It has got a duration 4.5 years, right? In that case, if RBI or Fed says that there is a 10 basis point increase in the market yield, okay, the finance manager of your country says there is a change in the interest rate by 10 basis point, the 10 basis point is 0.0010. So you divide by 10,000 to get the percentage. So it's 0.0010% increase or 10 basis point. So your delta y is this number, 0.001. Remember this, change in the prices. So percentage change in price is given by change in price divided by total price. minus D into delta Y. So delta Y is given, right? And price is also given, 96.54, into D, the duration. You multiply these guys, put a negative sign, you get this. And what you see is the change in price is 0.43443. You know the original price. Since the interest has gone up, can you see here? The price must drop. So the change is negative in nature. Current price minus the change is equal to new price, and the new price is less than the original price. Once again, we were given the bond price and the duration. I can use the formula where price is multiplied by duration into the change in yield. The change in yield is given to be 10 basis point increase. So it is positive. I have a negative sign here. So delta B, the change in price, comes out to be minus 0.43. Current price minus change is equal to new price. So I'm able to compute the new price given the duration of the bond. The interesting change is if your bond is continuously compounded, the duration is changed by dividing the Macaulay duration, the one we computed, by 1 plus R by N. Okay, where N is the total number of years of maturity and R is the discount or the return yield of the bond. So this is only for continuous compounding. Okay, so let's talk about the other part, which is called convexity. I have drawn a nice tangent and I call this slope as duration, a negative duration. But in real world, as I said, there is a curvature. There is a curvature in price-yield relationship because we all know that the price-yield relationship is formed by discounting the cash flows, right? We discount the cash flows to get the price. The price is equal to C plus the yield, C plus yield square, and so on. Since the relationship between yield and price is not linear, it is non-linear relationship and inversely related, the real relationship is curvature. If you took an approximation based on straight line, your answer would be incorrect if the changes in yield are large on either side. So for large changes in yield, you must consider this curvature to get the right bond price. So this curvature is called convexity, and there is a constant value for that convexity that we should compute. Okay, so convexity is a measure of the curvature of price-yield relationship. Okay, so it's a second derivative of the price of the bond. B is equal to price of the bond. Okay, so it's a second derivative of this, 1 by B. Don't worry too much about it. All you need to remember from exam point of view is this. There are two important insights that convexity reveals. Okay, the price rise due to fall in yield to maturity. Let's draw the graph again and understand carefully. When the yield to maturity or the interest rate in market fall, the price rise is greater. Can you see exponential increase? A small change in reduction in yield leads to a very high change in price. On the other hand, if the YTM increases, the decline in price is smaller. Can you see that? It's flat on this side and it's exponentially going up on this side. So rise of price is higher than decline of price. Okay. Or you can also say for a given change in YTM, there is a higher change in price when the interest rates are reduced than they are increased. Okay, at the lower YTM, there's a huge price compared to if YTM is already high this price is not very low. Okay, the change in price is quite limited. So we will compute the convexity by taking second derivative of the price of the bond. Remember that if it is a semi-annual bond, you must divide the convexity by 4 to get the answer. In general, you have to convert the convexity to any annual figure. You must divide by m square, where m is the number of periods per year, or number of payments per year. So there are 2 payments in a 6-monthly bond. So you divide by 2 square, which is 4. Okay, so what's our new formula? My more accurate formula after this is that change in bond price divided by bond price, which is percentage change in bond price, is equal to minus d delta y. This is same as old formula. I'll make a correction, plus c delta y squared. What is c? C is the convexity into delta y square, and I multiply by 0.5 as well. So 0.5 c delta y squared. So that's the new formula. You don't have to worry about its derivation for the exam. Just remember this formula. All it is saying is whatever the answer we got by assuming tangent, I have a correction factor, which is the convexity factor, to get the right value of the price of the bond. And I must apply the bigger formula with the correction factor if the change in the yield is quite large, either up or down. Okay, so let's take the example where we will consider convexity. Okay, so here the change in the yield is quite large. 1% is a quite large change, unlike it was 10 basis points in the earlier example. Here it is 1%. So the question is, by what price the bond will fall? Because the yield has gone up, the bond price should fall. Convexity is given to you. So the formula is change in price is equal to the minus duration, change in yield. The duration is taken from the past data. Change in yield, 1% positive, into the price of the bond. 0.5 convexity, price of the bond, delta y squared, the change in yield. So I used this formula and I got change in price. This one is much more accurate, which is minus 33.82. So my new price is 964.54 minus 33.82. Whatever is it, it's going to be less than the original price because yield has gone up by 1%. So once again, you've got a formula to compute the change in price given change in yield. Okay, so this is the last topic before we talk about the FRM program that is offered. This is the last topic which talks about what is DV01. DV01 is nothing. It stands for duration, okay, when the change in yield is 0.1, okay. The price value of basis point or a dollar value of basis point change is the absolute change in the bond price from 1 basis point change in yield. I want to fix my change in yield, the delta y, to be 1 basis point. Okay, so that's why the 0.1 comes in, 1 basis point yield. So if in my formula, where I say percentage change in price is equal to minus d delta y, now I am saying I have fixed it to be 1 basis point, which is 4 zeros and 1. Remember this much percentage, 1 basis point. Now question is, what is the absolute change in bond price? Okay, so the change in the bond price DVBP for 1 basis point change is nothing but minus D, okay, into 0.12341 into the price. So I take this B here and multiply with this. Okay. So I got this formula for dVBP, which always takes delta Y as 1 basis point. Okay. So put the same formula but get the answer in rupees or dollars, right? That's the unit, which is the absolute change in bond price, and it's always the change given the yield to be 1 basis point. At this point, I'll wait for questions from the attendees. I would answer some questions and go over the program, FRM program that is offered. Okay, there's one question which says why there is a negative sign in the formula, why it is percentage change in price is equal to minus duration into delta Y. The answer is you have a negative sign because there is a inverse relationship between change in price and yield of a bond. Okay, and because there's an inverse relationship, the formula is nothing but a straight line equation whose slope is negative. Does that answer your question? Okay. Waiting for more question. Okay, if there are no more questions, let me take you to the program that is being offered for FRM Part 1. This is the program which is offered by CARP, the FRM program, and we are providing the training for that. We are the exclusive training providers to give you a FRM level preparation. It's an online course. If you want to look at the online course, that's the charges. And what do you get from this training? You get trained by a very proficient FRM charter holders with a 50 plus hours of recording, 15 hours of recorded summarized learning, a big question bank, 800 plus FRM standard question, 2 proctored mock tests. We've got 24/7 online support. You can post your queries, get the answer, and not only that, you get access to our webinars like this one, right, which is worth USD $200. There's a money back guarantee within 30 days. If you don't like, no question asked, you can get your money back. There are big benefits from FRM. People who are striving for risk management as their careers must target this certification, widely known across the world, of professional certifications for banking and finance professionals. We've also got the FRM Part 1 exam to be held in November 16, 2013. Okay, if you want to participate there, you must connect to this website. It's EduPristine, right? CA courses FRM program. So you can go there and get connected. Okay, this is one of the classroom training that was online recording, which is conducted in Sharjah. There are, you can actually check a lot of places where the training is conducted. You can check a city close by and plan to attend there. And what all is in the classroom training? It's exclusive 6-day classroom training to leverage your FRM preparation. And it is highly customized for the upcoming exam. We've got up-to-date content and trainers will help you get the latest in place. Okay, so what you get is a 6-day, 48 hours exclusive classroom training. You've got online learning, which is 50 hours, 10 days online session for any revision, access to online forums, FRM charter faculty, mock test, online revision classes, and not only that, you get the nice FRM handbook, which is a focus notes, and mind maps, the visualized charts to help you summarize and remember just before the exam all the content. If you really wanted to know more about it, you can actually go to edupristine.com and look for FRM program in your close by area. Okay. There's one more key thing I want to highlight. If you go to the FRM1 classroom training, there's a link to ebook, and we have got a free ebook for you guys. Even if you do not want to enroll, download this ebook for exam preparation. It's very useful for exam. It has been prepared by FRM charter holder, and if you want to register, there's a link to the right to register for this course. Okay, so with that we close today's session. It talks about what is duration, how Macaulay duration is used, right, to compute the change in prices, and finally the impact of convexity was considered to compute the accurate value of prices when the change in the yield is quite large. So that was our last topic, to actually consider both duration and convexity, right, to get the accurate value of prices. So with that, we are done with today's webinar. Make sure you browse this website, EduPristine.com, for FRM program details. If there's any more questions, please post them. I'll get back in the next 10 minutes. Otherwise, we are done. Thank you very much.